I think that we're sort of on the cusp really of a golden age where we're seeing options move from being what we might have called the backwaters of the capital markets 15 to 20 years ago to now being extremely mainstream. And you look at at how often people reference the VIX these days as a way of explaining what's going on.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Welcome to episode 13 of Wealth Building with Options. I have a very special guest today. This is someone who is super well known in the options industry. You've seen his name in Barron's and the Wall Street Journal, both as a journalist, pioneering coverage of the options market, trading and exchanges, as well as being the subject of many articles as a force in the options industry, pioneering specialization in asset management using options, and working closely with the CEOs of some of the biggest options exchanges in the world. He was senior advisor to the chairman at the Philadelphia Stock Exchange and was involved in modernizing that exchange and creating and implementing the strategy that ultimately led to the sale of it to NASDAQ. And he was in the leadership at the International Securities Exchange, which introduced electronic options trading and was the first exchange to go public. He's the author of the book, The Indomitable Investor: Why a Few Succeed in the Stock Market When Everyone Else Fails. And this is the man who literally coined the phrase, the fear gauge, when describing the VIX index. Please welcome a man with a wealth of knowledge to share, Stephen Sears. Welcome, Steve.
Hey, great to be with you.
Steve, there's so much I want to talk about. We talk a lot about investing with covered calls and cash secured puts on the show. And I also like to talk about the mindset needed to make these things work, which I think maybe you talk about in your book a little bit, right?
Yeah.
Well, tell us about that a little bit.
Well, I think that we're at a point in time where everybody should have some type of options strategy working in their portfolios. One of the things that we've learned repeatedly since the bursting of the internet bubble, but especially since the global financial crisis of 2007 to 2009, is that volatility is something you have to manage, or else it will manage you. And one of the easiest, most elegant ways to do that is by selling calls or selling puts on stocks that you own or want to buy. And the mindset is not what people think it is, which is I'm being locked in like into a fait accompli. In fact, what we're talking about doing here is having a mindset that is focused on compounding, that is focused on risk reduction, that is focused on process over profit and risk before reward. And if you do these things correctly, I think most people are going to be very, very happy with the outcome.
So you mentioned a couple of interesting things there that are near and dear to my heart for sure. Compounding and risk reduction. These are things that, the way I see it, go so well together when it comes to covered calls and cash secured puts. But how do you fit those things together conceptually?
Well, I think it's pretty simple. One of the problems that the options industry makes is that everybody in the industry loves options. It's a way of thinking, it's a way of acting, and it permeates everything that everybody does. But the reality is that investors are primarily focused on stocks. So this is how I sort of see the options fitting into it. The first thing you can do and should do is build a portfolio of blue chip stocks that ideally pay dividends, that have strong thematic reasons for owning. You could be AI, it could be pharmaceutical research, it could be the war stocks like Lockheed Martin. And I'm of the belief, and I was taught this by some of the great index traders actually, that the stock market is chaotic and you can't actually know it. And so we create indexes to create this false illusion that we can know it. And but what I do think is oftentimes not well understood is that you can know stocks and you should know your stocks. And rather than owning 500 of them, you should own, well, I'm not going to give the investment advice on what you should own. It'll be different for everybody. But you could easily own 15 to 20 phenomenal stocks. And you could be able to know those stocks and study those stocks in the same ways that you know your spouse or your children or your pets. And then you have to curate those names. And the best way to curate them is obviously the easiest way is I buy more stock. That's generally what people will do. But a much more interesting way, I think, and frankly, a more impactful way is to curate them with options. All stocks have very specific behavioral characteristics, and by that I mean trading patterns. Each stock will have a different volatility regime. Each stock will have a different seasonality, and we can use options to enhance that return. Now, Einstein said that compounding was the eighth wonder of the world, and far too investors truly appreciate that in my mind. So what most people are focused on is this field of dreams type experience. I'm going to buy stock XYZ at 10, for instance, and then I'll get the mythical 10 bagger that Peter Lynch wrote about in One Up on Wall Street. Now, you and I know that the mythical 10 bagger is just that. It's mythical. It doesn't happen to most people. If it did, everybody would be a gazillionaire. So what you have to do then is focus on the mechanics of compounding. And what are the mechanics of compounding? We know that dividends on common stocks account for 45 to 50% of historic stock performance, depending over the time that you measure it. So inflation is like another, say, 3 to 5%. I'm going to rounding up and I'm rounding down a little bit, but that gives you the gist of it. So half the game, basically, pick a good stock, find a dividend, have a little inflation in the economy. And then how do you enhance that structural fact? I say it's with options. And I say that you will use technical analysis to identify how the stocks behave. You don't have to be staring at the screens all day long to figure these things out, but you do have to spend a little bit of time looking at it. I think you could do it for less than an hour a week if you wanted to. And there'll be certain times when the stocks are trending higher, you might sell a cash secured put. There might be times when the stock is trending lower and the skew is shifted a little bit, and you might sell the call. But all these things sort of come, they come with time, and you'll learn how to adopt your approach. That's how I see it. And I think if you can do that, you can create a very, very powerful compounding engine within your portfolio.
So you were part, I kind of want to dig into some of the stock selection stuff that you're talking about here. I find it really interesting just myself. The main premise of our podcast and the upcoming book is really on the option portion of covered calls and cash secured puts, but selecting stocks is a big part of it as well. And I consider myself more a student of that than an expert. I don't know. I, with pride, consider myself a student still of the options market as well,
Same.
for that matter. Yeah.
Same.
So you were part of two firms that were asset management firms specializing in options, right?
Yes.
Right? Yeah. Okay.
Yes.
And so, without giving away any secrets or anything here, what strategy or strategies did you use? And can you tell us a little bit about your experience selecting stocks in those funds and why and managing money in that fund and such?
Well, I think that we're sort of on the cusp really of a golden age where we're seeing options move from being what we might have called the backwaters of the capital markets 15 to 20 years ago to now being extremely mainstream. And you look at how often people reference the VIX these days as a way of explaining what's going on. The fact that they reference it incorrectly is another matter. But the fact that it figures as prominently now as the Dow Jones Industrial Average tells you everything you need to know about options. Now, at the firms, we dealt with a variety of of clients with very specific needs. And we would deal with family offices, we would deal with foundations, we would deal with some of the wealthiest people in the world, frankly. And then just your typical client who was, a professional and looking to do something more with their equities. Sometimes they brought their names to us, and other times they would seek counsel on what perhaps they should own and how they should do it. And what I generally found is that people who had some options experience or options curiosity would tend to follow the volatility. They'd follow the premiums. And they would reason that, well, I would much rather be trading a 40 vol name when the S&P 500 volatility is realizing 10 than looking for a more muted volatility. We would tell them, and I think that this first we'll speak about the options template. Well, we would ultimately try to disabuse them of that notion, right? That I know very, very few people who can trade options for the sake of options. And, Thomas Petterfee is one of them. Jeff Yaz, is another. And they don't even have normal minds, right? Thomas basically came up with Black-Scholes before the Black-Scholes guys invented the formula, right? So, but what I think everyone can understand is stocks. And I think that's really what people think of the world in stocks. So if you look at the characteristics of what are successful companies, you will invariably find yourself migrating towards, and this lends itself well to options, large cap blue chip stocks that pay dividends. And the goal where people psychologically trip themselves up, I believe, is they think that options are the field of dreams and they get rich quick, and they're not. They're a way to enhance your equity wealth without taking on an enormous amount of risk. Now, what I'm saying is almost heretical because if you look into our markets today, historically, we grew up when puts were more expensive than calls. Why? Because people are long stock, they want to hedge, they buy puts, it increases put vol. But today, everybody thinks stocks are going to go higher and higher and higher. So that historic fact of our market has shifted, and now calls are oftentimes more expensive or have higher vols, right? So you have to acclimate the client or acclimate the investor to a different mindset, and that what's happening in the options market is almost like Roman candles shooting up in the sky. What they need to focus on is their stock portfolio, because they need to focus on earnings growth. They need to focus on wide mode or narrow mode businesses. They need to focus on things like how fast are revenues growing or not growing? What are the profit margins? These are things that you can screen for. There are 12 sectors in the S&P 500. Should you own a few stocks from each one? Maybe. Is diversification dead? I don't. I think everyone has to answer that question for themselves, right? But when John Marshall at Goldman Sachs, who I think is one of the finest strategists, if not the finest strategist, frankly, on the street, and he's done more to organize the joint analytically and with data studies, often talks about using options to sort of bend the characteristics of stocks. And I think of this as sort of like, how do you create stock bonds? How do you create stocks that pay off with a reliable dividend, stream? And that's what continues to sort of intrigue me. And in terms of the firms, when you're dealing with very sophisticated family office people, they get that immediately. And they want that extra income, although that comes with tax friction, right? Because it's not long term. And the friction would invariably arise with, and I'm thinking back to an experience with one client where we made an extraordinary sum of money trading Apple stock on puts. The type of money that was made in 2 weeks, which if you had made that in a year as your salary, 99% of the people in America would have been, overjoyed. And that guy wanted his needle. He just move my needle, move my needle, move my needle. And he was ultimately so intent on fast returns that he was off balance, right? He was psychologically off balance. Although it had worked for him, he was a billionaire. So I think, you have to have this foundation of the stocks. How are you going to use the options? You have to manage the client, to manage investor expectations. And when you do all of those things, and I've shared all kinds of like a montage of thoughts and actions and ideas, but then you have to sort of stitch them all together. And that's the harder part for the portfolio manager or the financial advisor. It requires a little bit more sophistication. The client has to trust you a little bit more. Because what happens is the first time that you do it, when they get their first premium deposited into the brokerage account, it's a pretty big thing, right? And they like that. And then when they see the stock moving as the trade anticipated, they love it. And it's unlike anything they've ever really experienced, because at first, perhaps for the first time in their investing careers, they're no longer like a cork floating on waves of the stock market or even the options market. Suddenly they're actually like, steering their own ship, if you will. And I think you have to build upon that. And then you're going to get all these crazy ideas out there about, I'm going to do the most esoteric, intellectually arrogant strategies with 100 moving parts. And I just personally I don't think they work that well. They work for some people who are trading with other people's money and have like PhDs and work at French banks. But for John and Jane investor, everything comes back to the cash secured put and the covered call, and just doing it again and again and again and again.
Wow. Wow. So when interacting with potential clients, was it difficult to show people why they might even want to invest in a fund that uses options, and how it could outperform the markets? Was that difficult? Like, what was that like?
Yeah, some people would get it and other people blow their minds. They'd be like, but what do you mean if I sell a call on a stock in this? If I sell a call, 20 delta call, 10% out of the money, say stock goes up 30%. Like, I've left that on the table. I'm like, so what? You turn around, you sell the put. Right, right. That's one of the hardest things in the world. Or you're on a large concentrated stock position and you're managing a covered call program on that. And then an event comes, something happens, right? You always try to sort of tamp down around earnings or things that are known to be like big movers. But invariably over the course of the program, you're going to be the out of the money call is going to become in the money. Okay. And that freaks people out. Like, what am I going to do? And I learned this from a Barron's reader. You just schnitzel the position. It's like you can let some of the stock go, right? You can let it all go and you're done and move on. Or the Barron's reader had this phrase called schnitzel, like pounding down the veal cutlet. And so most people don't own just like 10,000 shares or 300 shares. They reinvest their dividends. And so there's always these random stubs. And so what we would do in these situations is like, fine, like who cares? You're in the money. Just because you're in the money doesn't mean that it's going to be called away. First of all, you can manage that liability until it ceases to be a liability, playing with time involved. Or the schnitzel is, I own 10,697 shares. I'm going to sell the odd lot and change my options position and then regain mastery of the stock in the options trade. And that's the type of stuff that really is hard for retail, for non-professionals to understand. You and I think, sort of see the world as a giant options montage in time and space. And the goal is to travel through it. And investors, whether they be the most sophisticated institutional investors or people just learning how to navigate the markets, see it much more as a maze in which they can't sort of necessarily get out. And we had this one particular fellow who had been a floor trader when the floors were open outcry, who we called him on the firm, we called him Yoda. And Yoda would say to us, in the money, out of the money, I don't care. It's the same thing as long as you keep getting paid. That type of a mindset and that type of a philosophy is very, very hard, I think, for people to understand. Some people get it and others don't. And I'll give you one situation, concentrated position, C-suite, retired C-suite, massive position, basis is too low. Something happens, the stock is in the money on short call program, stock's in the money. They're freaking out about it. We're like, what I described to you about managing it just doesn't resonate, because at that point you're like, oh my God, my tax hit's going to be so large. I thought that this was basically a license to print money, even though you told me, and we had language, for instance, like, to be sure, there is no free lunch, right? This is your risk factors. But people, they just don't think about their stocks in a healthy way, in a realistic way. And that can really compound how they view the options piece. And this client, their stock was in the money, you move it around, whatever. And they were like, no, you need to sell some of it, right? Like this is probably as good as it gets. And it was as good as it gets. And we sold some, and the stock is now 40% below where we sold it. But did they ever call back and say, hey, that's great. Thank you so much for doing that. Thank you. Now I understand how selling a call on a stock creates discipline in my program. No, they don't get it. And that remains the hardest part because even my dear mother will call me up and she say, what's happening with the stock market? And I say, Mama, well, it goes up, it goes down, it's normal, right? And people don't get that. And I think that if people did get that, that would make them much, much better investors.
What percentage of people that were clients, whether it's, advisory or investors in the funds, like actually got it as opposed to just, oh, well, hey, it's working. Just keep doing what you're doing. How did that work?
I would say that success begets understanding, right?
Hmm.
And what we found to be quite interesting in my experience in the options at the exchanges confirms this, is that there's education. You have to start out slowly. I always liken it to the Karate Kid, where Mr. Miyagi is teaching Daniel-san, how to wash cars, wax on, wax off. And we would have to start out quite slow. You never start out with the entire portfolio, even on institutions, quite frankly. And you have to teach them, show them, let them feel it. And then what we found was pretty incredible is that people, especially those with sort of a real analytical or mathematical minds, people from the computer industry, people from corporate finance, people who had to work with numbers and or the psychology, of crowds and things like that. Ultimately, what we were doing for them in their portfolios and go off and do it on their own in other parts of their portfolio, or they'd bring in other things for us. Now, obviously everyone has their own AUM thresholds, but they'd ask for book recommendations. They'd ask for all kinds of different ways to get smarter about it. And what we found is that, as I'm sure you find, is once people understand the power of acting and thinking this way, it changes everything that they do. But it's a lot of hand holding and it's a lot more back and forth than you would need if you were just running a straight up equity fund or equity business.
Yep. I get it, man. I've had that experience with my work with Market Taker for sure. So if you're selecting a stock to sell covered calls on, what
Yeah.
criteria do you use? I mean, like, is every stock a great candidate for something like this? Or
No, there are exceptions to everything that I'm about to say. And I'm speaking broadly, but everything has to be stressed and challenged. And I think that with options in particular, more pain and suffering is caused by people chasing hot stocks. And that could be like whatever you see on TV, should you waste your time watching financial TV or whatever you're going to read about, see on social. People gravitate towards like it's 100 vol, it's whatever. They may not even understand what the vol is. They just know the stock moves a lot. And if the stock moves a lot and I'm right on the call or put side, I'm going to make a bunch of money. That's not my cup of tea. I think that's one of those situations in which people, invariably learn that success in the market is really time in the market and that you're going to do much, much better over a 10-year period if you're not trying to, chase the bright, shiny things. So this gets back to stock selection then. So what does work? There was a study that John Marshall at Goldman did many years ago, and he found that contrary to popular belief that these more, stolid, blue chippy type names actually they were better option stocks than not. And so you can run a screen. One of the things that crack open any ETF, crack open any index, look at the top 10 to 20 names. And you're going to see certain characteristics on price to earnings ratios, forward and trailing. You'll see certain cash flow characteristics. And you can pretty much, if you've ever worked with CFOs or had access to the to industry analysts, those guys can create more models than you can find in a hobby store. But I think in general, what one looks for is strong cash flow. That's a great hallmark. Is it actually making money? Like, what's the debt levels? Are they loaded to the gills with debt? Or are they not loaded to the gills with debt? What's the PE ratio? Superficial. These are like first level analytics, and almost anybody can do. A stock above 20 PE is a growth stock. A stock, below 20 PE, maybe it's a value stock, generally speaking. And then do you understand what they do? I think that's really important. And then do you believe in that there's certain trends that animate the world? Like, for instance, every day in America, 10,000 people turn 65. And we know obesity, for instance, is also a big issue despite the anti-obesity drugs. So like, okay, are people blowing out their knee joints because they're too heavy? Yeah, they are actually. So you can look into that. So do I like Stryker? What does Stryker look like? What other stocks are like Stryker? And I'm not endorsing Stryker, but I'm giving people what I hope is a very easy to understand way of thinking about equities and analyzing them. Everybody that I know has an Apple phone. What does Apple look like? And what are the characteristics? And if you think of the equities like a kind of like cracking a fortune cookie, if you will, what's the fortune inside? It's going to be the analytics, and it's going to tell you that is revenue growing? Look at the past 5 years. Look at forecasting then for 5 years. What's the PE ratio been? How does the stock behave around earnings? What do the analysts say about it? And this is all, we have more financial information available to us than ever before, and we make worse and worse financial decisions. But like, do the analysts, are they all buys? Are they too positive? Are they all negative with sell ratings or holds? And these are the things that you can find on Yahoo Finance, on Barron's, or the Wall Street Journal. And then when you have these names and you understand, like, geez, well, this AI stuff, how are they doing that? Semis. Is Intel beat up? I don't really know. I mean, then you go do your fundamental research on it. What does that entail? Well, go read the annual reports, and you can get lost in them. They're really marketing materials, but what's not marketing is the MD&A section, or management discussion and analysis. So if you really want to understand about a company, go to the SEC.gov, or better yet, go to the company's IR, investor relations website, and pull up the latest regular quarterly earnings report. Go straight to the MD&A section, management discussion and analysis. They're going to tell you exactly what's happening with the company. And if I can do it and understand it with no specialized CFA, University of Chicago mathematical magic, you can do it. And once you do that, you're going to be like, God, now I understand this in a different way. And then you can build out your stock position. And then you'll have these metrics that you think give you some edge or some understanding of the company. And guess what? Because of the regulatory regime, is they're going to report every couple of months. And you're going to have them on your Apple phone. You're going to do whatever. You'll have them in your portfolio. Just follow the news on it. And you're going to learn how they behave. And guess what? Sometimes they go up and sometimes they go down, but generally they're moving in some sort of an upward motion. And then you'll go look at your options montages. And you're like, I really like this stock. I think I'd like to buy more of stock XYZ. And what are you going to do? Like, well, the normal person will go place a market order online, but an option-centric investor is going to do one better. Like, what if I told you you could be paid just to buy stocks as opposed to paying to buy stocks? Everybody wants to do that. So what do? I'm going to sell a cash secured put. And what is a cash secured put? I'm going to take the money that I otherwise would have used to buy the stock, deposit it into my brokerage account, and then I'm going to sell a put that creates the obligation for me to buy the stock at the market price or at a lower price. And then it gets down into trade styles and trade disciplines, like how do you select expirations? How do you select strikes? What role does volatility play? And I would tell you that at the beginning, and maybe even for most people throughout their time in the options market, volatility is probably not that important to them. So if you look at some of the biggest institutional money managers, mutual funds and guys like that, they have no idea what they're doing with vol. They don't even ask about vol. They're looking at the premium. So here's a very simple way, which one very well-known manager told me was his strategy. He does all the research, not terribly dissimilar to what I described earlier, but obviously much more in depth. He'll speak to management, he'll create models and do whatever, and he'll come up with what he thinks is the fair value of the stock. And he'll also come up with, at the same time he's building his position, he thinks the stock could be worth Z at a higher price. And if he's willing to sell it at that higher price, he sells calls at that higher price nonstop. 1 month out, 2 months out, 6 months out, whatever. Constantly paying himself to do that. Now, at the same time that he's got that exit price and he's selling calls when he's building the position, this is a very famous stock manager who told me this in confidence. He's selling puts on the name as well to build his position. Now, he might sell, he will buy enormous positions. And because he can therefore move the options to stock market with this type of demand, he uses similar scaling strategies on the puts. And lo and behold, the fellow tends to beat the S&P 500.
Wow.
Yeah.
Man, there's two more things that I want to squeeze out of your brain, Steve. One, so you talked about just now fair value of a stock.
Yeah.
So I'm wondering about your origin story as a value investor, as a stock evaluator,
Yeah.
analyst. And I'm picking up, tell me if I'm wrong. I'm just gonna guess. I'm picking up like a Benjamin Graham type vibe here. Is he one of your influences?
You know what? Benjamin Graham is very much part of the spirit of Barron's and even of the Wall Street Journal, right? So we're kind of trained that way. I'm much more into, frankly, growth investing.
Huh.
And when you say value, I think fear. Okay.
Huh.
So when I was just a wee kid starting out, I was so lucky because there were guys like you who there were all these really undiscovered, there were all these geniuses working in the options market, and no one had spoken to them ever. And I just got lucky. And they taught me a bunch of things that I think you would have learned back in the day, like we want to buy fear and we want to sell confidence. But the biggest breakthrough to me was when somebody from the CBU, said to me, he's like, look, kid, he said, bad traders think of ways to make money. Good traders think of ways to not lose money. And I was like, what? I remember it clear as day, and it was well over 20 years, 25 years ago. So I just look for stocks that have strong themes, right? And then I try to determine, like, do I think that theme like has legs? I think the markets are chaos. I think they're unknowable. I think they're a gigantic Tower of Babel that would make the biblical Tower of Babel seem like it was speaking in one voice. But what I understand, I think anybody can understand, are these thematics, right? And I've got certain things for myself that matter. Like I'll look at 20 PE stocks. I like to look at trailing first because you can't lie and BS about what happened in the past. And then I'll go forward and I use that to sort of gauge, sentiment and momentum of the business and the different constituencies. But so I'll have some rather low PE names, but I'll have stocks that could be trading at like, I don't know, 70, 80 PE. And like, you know what? I think the theme is, and the way I evaluate it is, do I think the theme is legitimate? Hell yeah. If I do, I don't really care. And I don't get too caught up in it. And I spend a lot of time trying to figure out like why my thematic view would be right. But I'm twice as interested in why it could be wrong. And then when I implement the stock stuff, like it's a value stock, it's a growth stock, I don't even think of the stocks that way. I'm so into the thematics of it that I'll use the options and I'll pull the put lever, I'll pull the call lever, sometimes at the same time, sometimes separately. Sometimes the stock will surge and then you're going to be wrestling, with your call. Sometimes it falls, you're going to be wrestling with your put, whatever. But that's how I think about it. And I've been interested in crowd psychology since I was an undergrad. And a friend who was in art school, believe it or not, had that McKay's book, Extraordinary Popular Delusions and the Madness of Crowds, and which basically chronicled all the great sort of crowd movements like the Tulip Mania, the Mississippi schemes, all of these moments in time when people went mad all at once, thinking they were going to like alchemy, turn base metals into gold. And I use that type of, crowd analysis as well. And I tend to view the stock market not so much, again, growth or value, but like, what if I was standing on the floor of an exchange and I was looking at the incoming flows? I put huge, huge weight in what's happening in the options market. I'll look at put call ratios, not in the same way that most people do, because I think they're super noisy because you can't tell if they're opening or closing. I get a lot of flow reports from some of the big firms, and I look at those. Sometimes I think they're misinterpreted. But again, everything is about the theme behind the stock. What do I think people understand? What's priced in? What's not priced in? Does the options market give us an edge in understanding the stock? Sometimes yes, sometimes no. And then tell me how I'm wrong, right? And then do I want to get out of the way of an event? Most of the time, yes, because I don't think that I have any edge or that anybody has any edge in earnings. I think it's a coin toss. Now, you know as well as I do that into an event, the entire street goes to the Bloomberg earnings function to look what's priced. I think it's like ERNS is the function. And like, if everyone's doing that, like, how can you think that you're going to know more what company XYZ is going to report? I could care less, right? So if I'm an options guy with a stock view, a long-term stock view, if I can, I'll shut my positions down. You shut your positions down in advance of the event. And then you open them back up after the vol is readjusted. And people are like, well, that's crazy because vol went, for discussion's sake, from 50 before the event because you don't know what's going to happen down to 30. Who cares? Right? So if you're going to pocket premium, a $2 premium versus a $4 premium, but you're going to keep the $2 versus you have no idea what's going to happen with the four, like, don't be an idiot. Right? So that's really how I think about stocks. I hope that wasn't too obtuse.
No, that was really, really great. So to me, I look at it as there's kind of two pieces of the puzzle. There's the stock component, and that was really, really great stuff on just your thoughts on, well, I don't know how to put it, valuing a stock, but I think that's not exactly the right nomenclature.
Yeah.
But the option is the other component. So let's talk about the premium level of the option. I mean, what comes into play there? Is it implied volatility that you use to come up with maybe a fair value of the option, or at least to make buying and selling decisions on them, or what?
Well, I would just simplify it. I think that over time, once you learn the foundational aspects of the options market, you should look at theta, vega. You should really look at the Greeks, right? And you can use that to sort of calibrate. But I think initially what most people should do is remember stocks first, options second, right? Not options first, stocks second, except for, a handful of people. So you're long stock. Let's just say that you own one of these thematic names or whatever. You pull up your options montage. Most people are going to be at 20 to 25 delta calls, right? I'm long the stock. Selling a call is easy because I don't have to come up with any money. I just securitize with my call and follow the premium to a degree, right? I think that's kind of the first easiest thing to do. Stock is at 30. If I sell, let's say 20 deltas, usually 10% out of the money, basically, would I be willing to sell my stock 10% higher this week, right? Or 2 weeks out? And if the answer is yes, and you think the premium's pretty good, like, cool, get paid to own the stock. Now, but before you do that, and this goes back to being a stock first, option second type investor, you go to the corporate IR site and you're like, does this company have any events? Because you don't want to be caught unawares, like, oh, they're good, you're doing this, it's into earnings and whatever. And you have to determine that calendar, right? And then the more advanced part is like, are they influenced by ISM data? How does this stock evolve around jobs data, like the FOMC type stuff? Most people shouldn't play with that at first. Then when you've done that a couple of times and you understand how your stock behaves relative to your strikes, you have to really deal with time, right? Like, where are you going to be? It used to be, as you know, that they'd call 3-month expiration cycles the buy right? That's the greatest liquidity was there. The exchanges in their never-ending quest to make transaction fee income has introduced shorter and shorter and shorter and shorter expiration cycles, so that basically most of the liquidity is not 3 months out, although it's still good, but a week to 2 weeks out. And because there are many professionals like you who are now in the money management side of it, these guys all love, they love theta or time decay. So you might start out by picking your expiration cycles 1 to 2 weeks out, which brings with it different sort of monitoring requirements. They're not set and forget. And I think when you start on that, I'm at 10% higher. I'm 1 to 2 weeks out. I look at my premiums. I look at my events. Then you'd be like, well, I wonder what the volatility is, right? Most brokerage firms, options platforms, not the standard like Schwab standard doesn't have it, but like Thinkorswim does. What's my at the money vol? Am I selling? How does my vol compare for this particular expiration cycle to the rest of to the year, to 6 months, to realize that's kind of like the second level of the options analysis. I don't think you need to be there immediately, right? You have to be like wax on, wax off. And you do that a couple of times and you understand it. You have to understand what it feels like psychologically and emotionally to have a win when you overwrite or underwrite. And you also have to understand what it's like to have it go in your face and how you're going to manage that. And the first thing is like, no one wants to lose money. It's a very, very bad feeling. But losing money and making money, they're really just different sides of the coin. And once you can sort of reconcile yourself to sometimes I sell calls and sometimes I sell puts and sometimes I have to trade my stock. Once you can reconcile yourself to that type of a transactional investment journey, you're bulletproof, right? It's like, who cares if you sell the stock and it goes up another 10%? You still made more, you still took in more than you had. And who cares if you sell the put and it goes down 20% and you're stuck buying it at 10%? If you bought it for the proper reason, if you think your thematic is correct and you were willing to buy the stock anyway, like, don't cry, trader op, investor op, sell the call, right? To get out of it. And then that leads you then into the Greeks, which are incredibly valuable, but not right away, because there's so many things to think about in the options market that it will blow most people's minds. Because my dad used to say when I was a kid, like, never give somebody more than three choices. They'll never make a decision. And the options guys, everybody loves to talk about all their stuff, right? And then now you have guys talking about, I think, Vanna and all these other things. Stop, right? So that's how I sort of see it. But if you can condition yourself to just think of how am I going to use stock options to be a better stock investor, good things will happen. You could be retired, for instance, and everyone, ultimately finds out that it's pretty hard to not have a paycheck. But if you've managed your stock portfolio well and you're in retirement and you have certain risk parameters that are involved with using options to generate income as opposed to trying to catch fire, you can be in a position of strength. You don't always make money, but by God, it's a lot better than, trying to eat cat food, if that's the case. Anyway.
Stephen Sears, thank you so much for sharing your time and wowsdom with us. That was really, really, really great stuff. Thank you.
My pleasure. I appreciate the opportunity to come and talk with you about this. Been a fan of what you're doing for a long time, and I only hope that my comments you get excited about this subject still. I think it's fascinating, and I hope that it contributed a little bit to what you're trying to do for everybody.
Thanks, man.
My pleasure, buddy.
Yeah, that was super.
Did I do okay for you?
Oh, God, yeah. I love it.
It wasn't too like...
Anytime I record something or write something or whatever, it's like it's done and I never look back. I might actually come back and revisit this one just to listen for myself.
All right, that's kind. I mean, I love it. You can change people's lives with it. Changed my life. I tell my mom, Mama, options has been very, very good to me.
And that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app, Spotify, Apple Podcasts, YouTube, whatever it is. When you do, you'll be the first to hear the next episode. And I will see you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.